Are you thinking of building or remodeling? I'm Brian Smith with Vision Design and Build.
And I'm Tony Tileman with Supreme Lending. You're listening to the At Home Real Estate Show.
And we're back. Welcome to the At Home Real Estate Show. My name is Brian Smith with Vision Design and Build. Been building and remodeling homes for over 25 years. I'm here with Tony Tileman with Supreme Lending.
Good morning, everybody. This is a really important segment. I'm very excited. We got Charlie Smith with J.C. Calhoun back in the office to talk to us about investment real estate specifically and cost segregation. So, Mark, if you could watch his mic because he's sitting back a little bit. Thank you, brother. But, Charlie, welcome.
Thank you, Tony.
And
it's good to be back.
And Happy New Year to you.
Yes.
Yeah, last time we saw you in a Christmas hat, you have saved us literally people we know. I think our total's close to $300,000 right now in taxable, what they were going to pay in taxes. That total right now is they're not paying those in taxes.
That's money.
And one of the comments was, so let's talk about, first of all, what is cost segregation? Let's go to basics.
Okay, so what cost segregation is, it's been around since the 1970s in various formats. Cost segregation is codified by Congress in the Internal Revenue Code. So it's, perfectly legit. What occurs with cost segregation is most CPAs will take the conservative approach with rental real estate, investment real estate property. So, for example, an apartment building is depreciable over 27 and a half years. So most CPAs will take 100% of that. But under cost segregation rules, you can break it down into the carpets, which have a 5-year life, the floor, the appliances, the demountable cabinets, blinds, the sidewalks are 15-year property, pools, and those types of things. So you can accelerate the depreciation deductions. And Congress passed in 2017 with the Tax Cuts and Job Act a provision called Special Depreciation Allowance. Now that's been around for about 10 years, but it hasn't been deductible at the extent it is. It initially started as a 25% deduction, and it increased over the years to now it's 100% deduction for the year placed in service. So any property that you can reallocate from longer life, 27 and a half or 39-year property, becomes under 20 year becomes deductible year one when it's placed in service.
So, folks, let's put that in simple terms, which I need to do for myself. We went through this on the last show, and we've got a couple questions specifically for you that we want to address. But if you buy a $400,000 rental and you qualify for this, because that's another caveat, you've got to be a real estate professional or qualify as a, what was this?
So many hours, I thought.
Yes,
200 hours?
You have to be active and material.
Active and material in the business. That's an important piece. But if you buy a $400,000 piece of investment property, the formula works out to be approximately a $50,000 net operating loss, which goes against your ordinary income. So what that means is if you had a $50,000 check due to the IRS, that $50,000 check goes away.
Yeah, I could make it a little bit simpler than that. For every dollar you spend, if you're at the top tax rate, 23 cents of that dollar will be a tax refund or tax you do not have to pay.
That's a big deal.
That is a big deal.
That's a big deal. That's a ring that bell, man. Okay, so a couple of the questions.
So that's almost $100,000 for a $400,000.
It is. Correct.
Yeah.
Wow.
That's $92,000.
Yes. So if you've got a piece of really good investment property, please go to the At Home Real Estate Show, athomerealestateshow.com. Find out how to get a hold of us and send me an email because I'm interested in buying it. Because we're going to be taking advantage of this year. Now, I had a client. She's got rental property. She's got a property down at a couple condos, and she owns a home locally that she has a home office in. And she says, "Well, I'm going to pay the tax eventually. So, is it really that big of an advantage? And then, what if I sell it in the next couple years? Did it make sense?"
No, it makes perfect sense to do the reallocation and cost segregation. Most CPAs do not understand this component of it, and we have applied it to multi-million-dollar projects. And I'm doing a hotel project right now where we have cost segregated the hotel it was sold, and now we're reallocating the shorter-lived assets back to the longer-lived assets. The internal, our practice is developed around litigation, representing clients in adversarial situations with the IRS. And so what we've been able to determine and develop is a strategy that takes the reallocated property, the 5 and 15-year property, we pull the appraisal district valuation numbers, and usually the personal property, which is the 5 and 15-year property, is has a lower value. And so we use that value, and that's the value the IRS uses in their audits of these. Then we're able to reallocate the purchase price back into and offset the 39-year. So it pushes what is normally called recapture, or 25% of the 5-year property, back into 20%, or long-term capital gain. In addition to, and see, the 25% is ordinary income. So you get smacked with ordinary income. So this pushes it into a 20% type environment. And in many cases, we're able to generate net operating losses on the shorter-lived assets.
So how would that work? Say if you had a property that was $400,000, and say Bear County appraised it at $300,000, but they sold it at $400,000, and you took in that rate of reallocation that year, and then 2 years later you sold it. How would that come in?
Well, basically what you're doing is you're saying that the property value that Bear County is using is the appropriate value for whatever the assets are that Bear County has identified on the appraisal district website,
Which is usually about 15 to 20% less. Although they've been
Yes.
up and a little bit better for the last few years. They used to be much lower as far as the county appraisals, and they've tend to go up a little bit now.
Yeah, and so all we're basically doing is just pushing the sales price paid, or the allocation that would be allocated to the 5 and 15-year property, back into the 39 or 27.5 property. So we're not changing the numbers, we're just reallocating back into the longer lived assets, which creates a capital gain instead of ordinary income.
So that's the deal. So that instead of recapture where it would be ordinary income, it's reallocation into capital gain,
Capital
which
gain.
it's at 20% right
Instead
now,
of the
correct?
higher percentage for your taxable, which is a 37 or 35%.
Or 40%. If you're at the top rate, you've got the 37% top tax rate plus 3.8% the ACA excise tax.
So you can cut your tax liability in half by doing that.
Correct, and that's why we do it.
Okay. So you were going to pay, oh man, that is amazing.
Yep.
Yes.
So
Yeah, that makes perfect sense now.
Makes perfect sense. Okay, Lisa, note to self, this may be something to look into. We got Charlie Smith here with JC Calhoun. Charlie Smith is an expert in property tax and this process we call cost segregation for investors out there. You were talking about somebody who had multiple properties
in business.
and can you share with us what you were talking about off air?
Well, there's a section now under the 2017 Act called the Qualified Business Income, or Section 199A of the Internal Revenue Code. What this was a production tax credit available for people who manufactured things. They made it available for qualified business income for real estate investors. And all it has to be qualified, the business income has to be qualified. It is generated as a primary business, which is called Section 162 income, which is ordinary business income. And for some, it may be available for a 20% discount. So it's something that every real estate professional that has investments in real estate needs to look into, or any other business professional.
So this is in addition to cost segregation.
That is correct.
It's not exclusive of.
No, it is not. It's
That's additional monies out there.
Is this a 20? It's a 20% credit.
It's a 20% deduction of the income.
Okay.
So when
if
you're
you're paying
talking
30
millions,
Give me an example of how that would work with some basic numbers.
Okay, so if you're in the 37% tax bracket, you're paying $100, you're paying 37 cents. Okay, if that $100 is qualified business income, then that 37% becomes 28%. And it's a 20% deduction against the 37%.
Okay, that was $37, not 37.
Right.
Yeah.
Yeah.
Correct.
Okay,
Excuse
but
me.
it's a big amount of money.
So when you have, like we're talking about with a hotel, those type of numbers, that 20% is big.
Now, our market primarily is realtors and builders, but they own investment portfolios. Okay,
Correct.
so this is from a residential real estate portfolio, not big commercial stuff. Does
if
it still work?
No, it still works. There are income limitations. If you make above $450,000 married filing jointly, it phases out. But under that, it's available to you.
Very interesting. Folks, this is the At Home Real Estate Show. All this information is available on our website, athomerealestateshow.com. Charlie Smith, JC Calhoun. Anything else to share with us?
Right now, we've been extremely busy. It's tax season with everybody seems to be coming with us regarding cost segregation right now.
Yeah, because we're spreading the word, man. No kidding.
It's working.
Yes, absolutely. I mean, we're doing it, right?
Right.
Yeah, and we've referred a bunch of people, so I'm just thrilled with this. It's made a big difference in our world. Folks, this is the At Home Real Estate Show. Tony Talman, Brian Smith, and we've got the Jody Trevino in the house. He's going to talk to us about San Antonio real estate coming up. Charlie, thanks for joining us.
Okay. Thanks a lot,
Stay
guys.
tuned.
You're listening here at 9:30 a.m. The Answer.